Good afternoon. We like to start right on time. I'll welcome all of you to the Bipartisan Policy Center. I'm Bill Hoagland, Senior Vice President here with the Center. Before I introduce our President, Jason Grumet, to present our 2019 Patriot Award posthumously, recognizing a former Vice Chair of the Federal Reserve, and before the current Vice Chair speaks, if you would allow me a point of personal privilege. It was 1975. I had just begun to work as a newly minted economist at the Department of Agriculture, and I received this phone call from a lady I'd heard about but did not know. She said they were creating a new office on Capitol Hill, an agency called the Congressional Budget Office, and one of the first bills to come up would be a farm bill. And at the end of the farm bill, there's a title on something we used to refer to as the food stamp program, now the SNAP program. And she said she had heard that I had developed a model for projecting the cost and participation in that program. And would I be interested in coming to that newly created agency? I hesitated, but later agreed. And so began my professional relationship with Dr. Alice Rivlin 44 years ago. Beginning with those early years at CBO and later as staff director with the Senate Budget Committee under the chairmanship of the late Senator Pete V. Domenici, my relationship and the Senator's relationship with Alice only grew over that period of time. After their years of public service, Senator Domenici and Alice joined up here at BPC to create the Rivlin-Domenici Debt Reduction Task Force of 2010, and they later issued numerous reports, fiscal reports, along with critical reports of the congressional budget process and needs for reform. While Senator Domenici and Dr. Rivlin had different political persuasions, I can assure you, and at times disagreed strongly on an approach to dealing with particular issues, their dialogue was always civil and respectful. On hearing that we were making this award today posthumously, Nancy Domenici, the Senator's widow, sent me a note to Dr. Winter, to Alan, Sherry Rivlin are with us today, and the family. It reads, "My deepest sympathies. Pete held Alice's abilities in the highest of regards. He was most respectful of her critical thinking and wonderful, clear writing. He truly valued their relationship and many years of working together. If Pete were here today, he would want to know, first of all, why did it take BPC so long to make this award to Alice, but he would also be giving the loudest applause. Nancy." Alice continued to work with me and our health team here right up to earlier this year, providing guidance and direction on the ongoing challenges facing our nation's healthcare system. She asked, and I was honored to review the comments on a chapter a book that she was writing right up before her death. Alice taught me that bipartisanship is not only essential, but critical to a functioning democratic system of government. I am glad I took that call 44 years ago. I owe so much, indeed the country owes so much to this great public service. She is missed. There's a passage from William Butler Yeats' poem, The Municipal Gallery Revisited, that I read to the BPC staff right before her passing. "Where my friends' portraits hang and look thereon, think where man's glory begins and ends, and say my glory was, I had such friends." To present the 2019 BPC Patriot Award, President of the Bipartisan Policy Center, Jason Grumet.
Well, thank you, Bill. As you can tell, Alice is beloved here at the Bipartisan Policy Center, And earlier this year, the board and leadership of the BPC selected Alice as the recipient of our 2019 Patriot Award. The award was created several years ago to acknowledge leaders who have performed public service and patriotic deeds worthy of remembrance. Former awardees include Governor Tom Kean, Congressman Lee Hamilton, Representative John Lewis, Sam Johnson, and Vice President Joe Biden. And I was delighted to have the opportunity to make Alice aware of this honor, but we were not able to have a ceremony to present the award before she passed. And so really deeply gratified that Alice's husband, Sidney, and family members are here to accept the award and to give us the occasion to share our affection and admiration for a leader who really epitomized the grit and the grace and really the joy of public service, from her roles that you are all familiar with at CBO and OMB and Treasury, to her leadership of the DC Financial Control Board. Alice's legacy of achievement has really left an indelible imprint on our democracy and on the city. But our admiration for Alice, as Bill notes, was neither distant or casual. She had a pivotal role in the first decade of this organization. As a staunch believer in fiscal sanity, she and Senator Pete really helped put BPC on the map and created an example of rigor and ambition and collaboration that the organization has strived to replicate ever since. Those of you who know Alice also know she was fearless. She was funny, she was strategic, incredibly productive, and authentically interested in other people, which is a very rare trait among PhD economists. While she's achieved many, many laurels, rest was certainly not part of Alice's agenda. And as Bill notes, until hours before her death, she was working on her book, Divided We Fall, Why Consensus Matters, that we understand will be released later this fall. It was really, truly a privilege to know and work closely with Alice. Her remarkable intellect, quick wit, and incredibly bright smile just made us all a little better. And so, Sid, it is with gratitude that we present this award to you and your family. And on behalf of everybody, thank you for sharing Alice with us and with the country. Patriot Award. Thank you. Oh, great. Gotta be there, buddy.
Okay, good.
Whoops. Don't want to lose it right away. Perhaps you could take it. Yes, thank you. Thank you, Jason. Alice was very pleased to learn of the BPC Patriot Award. I announced it to her over lunch on, I think, April 29, after I heard of it by email relay from Abby Dirac at Brookings. Alice, by that time, had pretty much given up on dealing personally with the massive flow of her email. It was clear that she was unlikely to be able to appear at a ceremony to receive the BPC award. To be frank, Alice at that point was not a person in need of more recognition. She just wanted to get on with the main business of her life, while she still had some life to dedicate. Precisely in that context, the BPC award meant a lot. It recognized her continuing efforts to do what she most wanted to do, namely, to make democratic governance effective in the cause of the general welfare. The recognition per se mattered relatively little, I think, but the BPC and its efforts mattered a lot. They were close to her heart in the difficult times, the personally and politically difficult times, in the years and months before her death. I have to mention in particular her rapport and friendship with the late Pete Domenici, with whom she collaborated under BPC auspices. Skeptics are skeptical about bipartisanship. It's part of their job. Cynics are cynical about bipartisanship. It's their nature. Alice, however, had her main answer to such critics ready and only waited for opportunities to pounce. She would say, as she said to me personally on many occasions, after listening to one of my frustrated rants, she would say, "So what would you do?" On that question, most critics fell dumb, or perhaps propounded very dubious scenarios about future election outcomes. The only compelling answer is the one Alice adopted: to work to restore bipartisanship with the help of groups like the BPC. Because without bipartisanship, there is simply no exit from our deep problems as a democratic society. I am very honored to accept this BPC award on behalf of my late beloved wife and her family. She did so much, we cannot hope to match her. We can only try to carry on in her spirit, but that at least we and you can do. Thank you.
Good afternoon. I'm Mark Walsh. I'm on the board of the Bipartisan Policy Center, and I just would like to remind the room to set your phasers on stun, please, because we're going to be both on camera but also listening to some great talks and interaction for the next hour or so. I was also proud to be one of the members and co-chairs of the Task Force on Main Street Finance here at the Bipartisan Policy Center, joined by such luminaries as Karen Mills, former head of the SBA, rather, Paul Grieg, who is CEO of a major bank in the Midwest, and Senator Olympia Snowe, who is also a board member of the BPC with me here. I encourage you all to visit the BPC website and download and consume our fabulous report on the Task Force on Main Street Finance. But to the data at hand and the event at hand is for me to introduce our two speakers as we start this great conversation. One is an interlocutor. That's Steve Leisman. He's with CNBC. Before that, he was with the Wall Street Journal. And I'm sure many in this room, and many, would join me in thanking Steve for his fabulous, informative, and incisive coverage of economics, as he is their senior economics reporter at CNBC. Steve will be questioning closely and sharply, I'm sure, our guest of honor today, and that's Vice Chairman of the Fed, Randy Quarles. Randy became Vice Chairman of Supervision in September of last year. Prior to that, he had stops as a public servant at the Treasury, the International Monetary Fund, and in the private sector at the Carlyle Group. He's a graduate of Yale Law School and a philosophy and economics major. Thank God for that second part of the major at Columbia University. So please join me in a warm BPC welcome for Steve and Randy.
I'm here. And I just want to thank the Bipartisan Policy Center for inviting me to moderate this discussion, and Randy for agreeing to do it. And I think people just need to understand real quickly, Randy has this interesting job where you're Vice Chairman of Bank Supervision, but you have all the responsibilities of monetary policy as well, but you only collect one salary. So it's like double the work.
You left out the FSB.
FSB, right, that's the international part, right. It means you're on a plane.
Yes, each takes 50% of my time.
How many trips, right, exactly, three things. Which is sort of where I want to start, and I do want to talk about Alice as well, but I'm going to come back to that. But let me start. The chairman, the last several days, spoke fairly plainly about the need the U.S. economy has for accommodation. Which means easier monetary policy, I guess, to most people. Do you agree with that? And if so, why?
Well, so I think if you look at the data about the U.S. economy currently, it's in a very strong position, right? Everyone's familiar with the unemployment rate figures, the lowest they've been in half a century. Current job production is well above what's necessary to absorb new entrants. Productivity measures is something that I've been very focused on and thinking about both the current state of the economy and the evolution of the economy. Over the course of the last year, that's been materially higher. Productivity has been than it has been in a long time, and that's consistent with some of the things that I've expected. And so if you just look at the current data, it's a very strong economy. On the other hand, there are some significant risks out there, and part of our job at the Fed is to think about what are those risks. We've been calling them cross currents. Global growth is, the case for continued global growth is not as strong as the data around the United States, and that will have effects on us. Uncertainty about trade is also something that is having effects on business sentiment, the willingness of business to invest. And we've been seeing that at least show up in some of the data in restrained business investment figures over the course of the last year. So as a matter of risk management, as a matter of thinking about the course of policy, I'm not going to predict what we're going to do at the next meeting, which we'll decide at the next meeting with everyone gathered around the table and all of the views presented. But I do think that all of those are factors that will have to be taken into account, and especially those cross currents and risks, will be something that we're factoring in.
So the reason I talked about both of your jobs is because I was asked a question this morning: what if the Fed gets it wrong? If it eases when it shouldn't be easing? And the first thing that occurred to me was we have excesses in the economy build up. And then it occurred to me, well, if excesses in the economy build up, then you're going to blame Randy. So I'm wondering how concerned you are about the possibility of getting policy wrong to the downside and concerns about excesses in the economy, in markets especially, building up.
So that's related to kind of the fundamental question of the relationship between monetary policy and financial stability risk, right? And it has become, I think, the most common view, and I share the view, that the best way to address financial stability risk is with financial stability-centric tools as opposed to monetary policy. I mean, a case can be made for the opposite view. I think Jeremy Stein would occasionally make the case for the opposite view. But on the principle of the right tool for the right purpose, I think that financial stability tools for financial stability risk are the right tools. And we have only a limited set of them in the United States. But then if you take that position, that evolves then into the question of, well, the principal financial stability tool we have in the United States, macroprudential tool, is the countercyclical capital buffer. So if we're, as a matter of risk management, if we're moving into a case where for risk management purposes, perhaps policy is going to be more accommodative, and maybe there's a potential for a mistake there, accepting your hypothesis, shouldn't we, as a matter of risk management, turn on the countercyclical capital buffer? That's a perfectly reasonable question to ask. When you look at the actual situation we find ourselves in, we consider financial stability and whether we risk quarterly at the Fed as part of leading up to an annual decision as to whether we'll turn on this countercyclical capital buffer, which is, for those who aren't steeped in all of these acronyms and technical lore, is a measure that will allow us to increase the capital requirements of banks at moments in the business cycle where we seem to be at the top of the business cycle, to allow us principally to be able to turn it down as we move then into a downturn of the business cycle, and therefore to stabilize, to cushion, if you will, the potential risk to the financial system of those sorts of boom and bust cycles.
Give us an idea of the magnitude of that, Randy. How much is the normal buffer, or how much is normal capital levels, and how much would they go up if you were to turn that thing on?
So the internationally agreed framework for this countercyclical capital buffer, has...
And nobody's put it in place yet, right? Nobody has...
many countries have put it in place.
Okay.
The Brits have turned it on and turned it off and turned it on again. So around the world, we have a reasonable amount of experience with this, and it could range from half a percentage point to a few percentage points, right? I mean, the view is that the relevant authority would come to a view as to what kind of an additional buffer is needed given the level of financial stability risk, and then would create that additional buffer with the ability to bring it down again as one moved into the bust part of the cycle. In the U.S., though, so we have this quarterly review of financial stability risk, and as it turns out, every time we review them, although we see areas of increased risk of the various areas we look at. We see areas of increased risk in some areas of asset valuation, equity markets, commercial real estate markets. We see areas that we look at, that we analyze the level of business debt, for example. These are all issues that folks here have talked about. So we look at that, then we turn to the final area of our analysis, which is leverage in the financial sector. How much capital is there in the financial sector? And there is so much capital that it tends to swamp everything else. Every time we go through this analysis, we conclude, well, financial stability risks are not meaningfully above normal because there's so much capital in the banking sector. And a way of expressing that, as I've continued to think about that, is that as we calibrated our through-the-cycle requirements, separate from this cyclical ability to have cyclical additions, as we calibrated our through-the-cycle requirements in the United States, we calibrated them at the very high end everywhere. In some cases, doubling what the international minimums were agreed to. Perfectly sensible to do that, but the effect of it is that our countercyclical capital buffer is effectively on. We've never turned the countercyclical capital buffer itself on, but we have created an extra amount of capital so that every time we sit down and look at financial stability risk, the capital in the banking sector is such that it says the risks are not meaningfully above normal. The reason for a countercyclical capital buffer is, would be to say that as you come to a place where financial stability risks are rising, you would add more capital into the sector in order to reduce that leverage so you could get to the conclusion that we keep coming to, which is that risks are not meaningfully above normal. We have never had to do that because we have now the problem with that is, I'm sorry this answer is so long, but each piece as you go through, the problem with that is that we therefore don't have a way to turn it down. And so as you think about, do we have the right financial stability tool?
You have to get it to normal capital levels in a downturn, is what you're saying.
Exactly. We would have to change the through-the-cycle
counter-cyclical capital buffer.
Right. And that is a big administrative process. That's a huge Megillah, let alone the political economy of doing that, to actually reach into what are supposed to be static measures and say, well, we're going to turn those down. It takes a couple of years to change a regulation, which these things are done, as opposed to...
It sounds to me like you've just made a case for reviewing the capital level now so that you could have some flexibility with a capital buffer in times to be actual cyclical.
So one thing that the Brits have done, which is very interesting, who have the most international experience with the use of this tool, the countercyclical capital buffer. So they've gotten that experience. How do you gain experience through bad judgment? They've gotten their experience through their Brexit ordeal. So they've turned it on, they've turned it off, they've turned it on again, and they've increasingly come to view that the principal benefit of this buffer is less to if you will, row against the current in the boom time, and more to be able to turn something down in the down part of the cycle. So they are actually taking portions of their through-the-cycle capital and turning it into countercyclical capital buffer. In other words, turning the countercyclical capital buffer, instead of something that will turn on in the boom, it's always on as a flexible layer of capital at the top. And because they believe that their system is appropriately capitalized currently, they're not adding it on the top. They're taking some portions of their through-the-cycle capital and turning it into this flexible.
Is that something we might do here?
So I think it's something we should think about.
Okay. You've completely destroyed the order of things that I wanted to do. But rolling with the punches is sort of what I get paid for, so don't worry about that. I'm going to come back to bank supervision. I had one more question about monetary policy. Actually, I've got a bunch, but let me just throw this one out here because it sort of relates to what we're talking about, which is market pricing. And I've got two questions about market pricing. The stock market appears to price what it expects you to do. There's a Fed funds futures market, there's a bond market, there's like $110 trillion of assets around the world that price their expectations for the Fed. One is a specific question. All of that pricing is, actually there's three here. All of that pricing is leaning towards the idea of not only accommodation coming in July, but coming in the next several months, additional accommodation coming. So I need to ask you specifically, is all of that stuff wrong? Secondly, that's not a joke question. I don't know why you guys find that funny. I always miss my own jokes, but okay. Secondly, do you feel a responsibility to guide the market toward correctly pricing in what the Fed is going to do? And thirdly, does all of this box you in for your ability to make policy?
So does the market have it wrong? I think the only answer to that is we'll see. Because our job is to respond to the data as it evolves. And I, at this point, I would not be prepared to predict, as well as I'm sure someone would come out of the wings and wrestle me to the ground were I to try to predict. But I would not be prepared to predict what the decision would be at the next meeting. And the decision for the meeting after that will depend on how the data evolves. But it's closely related to the second question of are markets correctly evaluating the likely decision function of the Fed, if you will, the response function of the Fed to evolutions in the data. So, the markets, pricing in future rate cuts, if you will, is they're having a view about how data are likely to evolve and therefore what we're likely to do in the face of that evolution. And that puts a very high premium on our correctly describing what it is that we're likely to do. None of us can we have to have views, we can't really predict how the data are likely to evolve. But we ought to have coherent enough intellectual frameworks in which we're thinking about monetary policy that we can communicate that and that people can have a reasonable idea that if things evolve this way, then the Fed is likely to evolve this way. Now that's a further complicated issue with the fact that the decision is taken with a full complement. That's 19 people around a table, and I think that is that function of Fed governance is underestimated a lot, even by quite experienced Fed observers. That when I first arrived at the job and Janet Yellen was still the chair, one of the first things I said to her after a couple of FOMC meetings was, I knew you had an important job. I had no idea how hard it was because everyone thinks that your job is to figure out what the interest rate ought to be, but you also have to manage this, motley crew of 19 people into a sensible outcome who all have different ways of thinking about it, even if they agree on what the outcome ought to be. Right. And therefore, the communication from all the various members can be difficult for markets then to interpret. That President Bullard thinks one way and that I think one way, and then Jay's job is to communicate for the committee, which is not necessarily his particular view, but he has to communicate for everyone. It's an enormously nuanced and complex process. But the job of Fed communications is to try to ensure that we are as clear about it as possible.
When you go to the meeting and the market's priced to X, do you feel a responsibility to deliver X? And if you're not delivering X, did you do a good enough job leading up to the meeting in guiding the market?
So I don't think that we should feel a responsibility to deliver X if the market is predicting X. Now, which isn't to say that we don't take the potential evolution of markets into account, because that obviously affects financial conditions, it affects the performance of the real economy. So, so potential market reactions to policy decisions are not irrelevant, because if you thought that markets were to do something that you thought would have a real economic consequence because of the overall effect on financial conditions, then you need to consider that. But it isn't. It both isn't a factor, and I don't think it should be a factor for us to say the markets are expecting us to do X, and therefore we need to do X. That's not really a limiting factor on our decisions.
You're happy to, okay.
I don't think it should be. I have the great luxury, of course, that Jay doesn't have, is that I don't speak for the committee.
Right.
I just speak for myself. So
Sure.
I don't think we should.
Sure. So I want to take a break from this sort of discussion, and we'll talk about supervision next. But first, I want to ask you about Alice, and I just want to say a personal note. I knew Alice well. I talked to her in her various capacities over the years, and I had a really hard time after she passed going on TV and talking about her. I didn't quite know how to do it because Alice was a very well-known economist in her own right, but she was also the first woman economist in all of those jobs. And I didn't want to be like, well, she's well-known and great because she was the first woman. She wasn't, because when it came to the CBO, she was the first person in charge of the CBO and the first woman in charge of the CBO. So she was all of those things, and I found it sort of difficult. I didn't want to emphasize one over the other, especially I did want to make the point because of the issue of women in economics, how important it was that she was a woman in those jobs. But anyway, your sense of the loss of Alice and the legacy.
Alice Rivlin was, in my view, really the paradigmatic public servant. She stood for, by reputation, I didn't know her nearly as well as I think most of the people in this room did, but I didn't know her and admired her enormously for all of my life because she stood for careful and clear and critical evaluation of issues. She was into the details. She was eager to deal with the plumbing because the plumbing is very important, and too many people in Washington, want to deal with the cosmos as opposed to the plumbing. And I've taken that as an example for my own forays into public policy, is that there's got to be somebody who's dealing with the plumbing, and she was, and also. She stood for me, at least, I hope for many people, as an example that you could be really committed to policy issues, to ideas, and to politics without succumbing to the shirts and skins mentality that characterizes so much of Washington.
Thanks for that. I'm going to move now to the supervision portion of the discussion here, and I think we might get back to the broader economic ideas here. And I want to start with the broad political framework. And it's interesting, you said, I know you, Randy, as a person who's steeped in these details. I just imagine what it must be like at a cocktail party talking to you. I was just like, and I don't mean that pejoratively.
People try to avoid that.
I don't mean that, I'm sure. I mean, but anyway, at the same time that you are steeped in the details, you have to think about the broad political framework. And that framework is, whatever the sense, this is my opinion, whatever the sense of altering the Dodd-Frank rules, the politics of it is you're watering down bank regulation. How do you handle that political fallout? And if you think I have it wrong, I'm happy to, but that's where it seems to get relatively quickly demagogued, and where when you hear about the discussion, for example, in even the questioning of the chairman today, that's what comes up.
So I think the best that we can do is, is to. I think the best that we can do is to do our job. I mean, yes, you're correct. I was expecting that when I took this job on, that it didn't matter what we did, we'd be accused of watering down bank regulation. I was a little surprised at the degree to which the very first thing we did, quite intentionally so, was a modest recalibration that was virtually impossible to characterize as watering down bank regulation. And I thought, so, if the very first thing we do, everybody says, hey, that's kind of smart, and that's not watering it down, and if that's the path they're going to go down. And we were creamed by everyone, including the editorial page of the Wall Street Journal. It was just flabbergasting. Because there's really no way that you could dispassionately look at that first move, which is a recalibration of the enhanced supplemental leverage ratio, which is one of the reasons people don't want to talk to me at a cocktail party.
There's got to be someone out there. Got to be. Just got to keep looking.
But we did this recalibration of the enhanced supplemental leverage ratio in a way that there is no way to view that as anything other than a net positive for the system, whatever your view about bank regulation, and that was viewed as watering down. So at that point, I said, well, then the only thing we're going to be able to do is to follow what our intended path is, which is, I think, what any responsible organization would do. A huge body of post-crisis regulation was put into place post the crisis. It is impossible to imagine that something that complex and variegated could be implemented without being able to benefit from some recalibration in light of a decade's experience, which we have now, and to go through and to say, without changing the objective, which is to ensure that the system is better capitalized, has more liquidity, is easier to resolve, are there ways that we can make it more efficient? Because very sensibly, you know, as in the battlefield conditions of the immediate post-crisis, people were not thinking about efficiency. The firefighter, to mix my metaphors, the firefighter going into the burning building does not think about the most efficient way of getting the fire out. He just has to get the fire out. And now we have the benefit of saying we have a fair bit of experience, and surely there will be ways that we can achieve the same objectives in a more efficient way. We will have turned some dial somewhere up too high. We may have turned some dial somewhere too low. One of the things I have talked about, I put on the table for international discussion is, you know, we don't have any standardized rules about liquidity at international bank branches, and maybe we should. For reasons that we could get into. But as you look at that on the basis of experience, there'll be ways to recalibrate it that will not weaken it, but that in fact will make it a better system. That's what we've been doing. I am very comfortable defending each of the changes that we've made. And so you just have to recognize that, you know, when I go up for my semi-annual testimonies, half of the Congress will be accusing me of exposing the soft white underbelly of the financial system to the next crisis. And I just don't think we're doing that.
Do you worry about the fallout from the comments you made about the stress test, which, frankly, I thought were pretty amazing? You said the Fed is not an adversary in this relationship, it's a teacher. That you don't want them to fail, you want them to pass. Doesn't that sort of change the dynamic or the sense that most people have of the dynamic, that there is an adversarial relationship between the regulated and the regulator?
I would say, so I don't think there should be a collaborative relationship between the regulated and the regulator. My objective is not to be everybody's favorite uncle, but I do think that our objective with the stress test is to ensure that we have a safer financial system, and the measure of that will be when all the banks pass the test, when we have an increasingly stringent test that all the banks pass because they are getting safer and safer. And there has developed, for a variety of reasons, I do think there has developed an attitude among some that we are only being effective as regulators to the extent that there are a bunch of banks who are failing one way or another. We must not be being tough enough if banks are failing. I view that as how else would we measure success unless we say we have brought the banks to a position and the system to a position where when we put it through a very strong stress, everybody passes. That ought to be what we want.
I'm going to let, there's some very smart people out here on the banking issue, let them deal in some of the details. I want to ask about one particular detail, which I have followed. I guess I followed the passage of Dodd-Frank, which was going to be Cork or something else before it was Dodd-Frank, as I recall. And there's some smiles out there, people who remember that. I call it Frankenstein, but it's the Volcker rule. And I understand it's actually still alive. And not only is it alive, but you're actually, am I wrong, going to actually adopt a rule on this thing pretty soon?
We are going to finish the proposed amendments to the Volcker rule, exactly. I think sometimes over the last few months, some people have thought that maybe it's like Clarence Beeks in Trading Places, and at the very end of the movie they say, Beeks, whatever happened to that guy? He is not in a cage somewhere on a boat, but we've been working on that. I mean, if you look dispassionately at the length of time that we have been working on the changes to the vocal rule, we are well within a sort of a very muscular speed, I would say, to doing that. And I would expect that early in the fall we'll have a proposal out that responds to a lot of the comments that we have received. That process has been continuing to go on.
And this will deal with the trading.
That would deal with the prop trading piece. Again, as folks who've been following the issue here know, there's also the so-called covered funds piece of the vocal rule, which we didn't actually put a proposal out on yet. We asked questions about what kind of a proposal we might put out, and so at essentially the same time, we would put out that proposal as well as have a conclusion on the prop trading piece of the vocal rule.
So I think the natural follow-up you have to answer is, do you believe the vocal rule will be adjudicated one way or the other in the time that you're going to be in this job? But we can just go. We can go on.
Absolutely.
After that, I do want to ask you a question about a place where monetary policy and banks meet, which an interesting question of a friend of mine, Peter Fisher, who's out there now. Does the Federal Reserve need to act in a way to steepen the yield curve so that banks are healthier and their lending is more profitable? Should that be something that animates Federal Reserve policy?
The short answer to that is no, and the reason that I didn't just sort of immediately say no is that there are a lot of very complicated assumptions and considerations that are included in that. We do have an interest as a central bank and in connection with our responsibilities as a central bank in ensuring that we have a healthy financial sector that can support activity in the real economy. One of the things I did at Carlyle was that I invested in a lot of smaller banks. Up to that point, a lot of my career had been with very, very large, complex, diversified financial institutions. And for a small community bank, you live on your net interest margin. You live on on that part of your income, and that is obviously very much affected by a flat yield curve. And yet, even in the period of the flattest yield curve, banks have been able to manage their net interest margin, notwithstanding a flat yield curve, so that they continue to be profitable enough that I think that they can do their job. So the relatively simple relationship between flat yield curve, that means a non-profitable banking system, certainly for the greatest number of banks, the smallest banks that support a lot of the small business lending in the economy. And so don't we have an interest in steepening the yield curve in order to ensure that that part of the system is healthy and can do that part of the job, which is an important part of the job, particularly with respect to job creation. I think that the industry has shown itself capable of managing its net interest margin even in the face of differing slopes of the yield curve, that it can continue to do that job. And therefore, I think that our principal objective with respect to monetary policy ought not to be to look at managing the slope of the yield curve for that purpose, but for a broader monetary policy.
What about the idea that you look at the yield curve and it's a signal from the market that the short end is too tight? That you would loosen policy and that would restore steepness. And everybody knows what I'm talking about, which is the differential between short rates and long rates. And the lower a short rate is because banks transform these things, I'm just explaining to people, that it makes it more profitable to lend. But the idea that it's a signal from the market that the Fed is too tight.
I think that I think that it can be. I think that in any particular circumstance, we at the Fed, in considering what signal to take from a particular shape of the yield curve, we have to consider what we think the drivers are. Like a doctor looking at a patient. If a patient comes in with skin that's warm to the touch, he might have a 24-hour bug, he could be dying of cholera, and maybe he was just sitting out by the pool for an hour. And there are different responses depending on what it is you think has been causing the warm skin. As you look at the shape of the yield curve, I think that certainly up until very recently, maybe the environment is changing somewhat, and then we have to see how the yield curve responds to the change in the environment. But certainly up until very recently, at the Fed, we were raising and we're expecting to raise the short end of the yield curve. We still have, a balance sheet that is putting pressure on the long end of the yield curve, and so you would expect that to result in a flatter yield curve than normal, without that necessarily being a signal of market expectations about the future, something that we ought to be taking into account in our own monetary policy. I think that's been the case at least up until very recently, and then I want to see how it evolves as policy evolves going forward.
I'm going to open up the question in just a few minutes. There's one sort of basic question I do want to ask you, which is to give us your general outlook for growth, employment, and inflation this year and next.
So I'm a bit of a sunny optimist myself. I think that we are. So I think that we have been for a while in a cycle of kind of increasing supply-side-led growth. We are in the process, and have been. This has been for a couple of years, a few years. It's not dependent on particular political events. We're in the process as a country of rolling out a wave of new technologies that I think will be very supportive of increased productivity. The immediately prior wave, the immediately prior decade of technological advance was certainly creating value in the economic sense, but was it really creating productivity? Certainly if the invention of the smartphone has not on any intuitive way increased my teenager's productivity, nor my own. I'm a much better chess player than I was, but I think that things like 3D printing and artificial intelligence, machine learning, 5G communications, all of that, those are communications that we have been rolling out for some time. We're still in the early stage of that. That ought to really increase productivity. That increases our ability to grow in a non-inflationary way. Those are all very positive developments. The fact that we're doing that is consistent with the increases in productivity growth that we have seen over the course of the past year. You'd expect that to happen. As long as I've been participating in the FOMC discussion, I've been saying we're going to see this happen, and it has happened. That's always very gratifying. And I think that's been supported by measures such as the tax bill at the end of 2017, which did have incentives for additional business investment. And the issue that, so I am over the course of the next few years, I'm an optimist as to where the U.S. economy can go and where it is most likely to go. But as I said at the outset, at the current juncture, there are also, these issues that I don't think are going to swamp that long-term trend, but that we do have to take into account with respect to how will we in the short term respond to what may be disruptions globally. How do we respond to perhaps a gap of some period, or some period of people holding back on potential investment while they wait to see how the trade situation will develop. That can have implications for what particular short-term decisions would be. But on the near to long-term evolution of the U.S. economy, I'm very positive.
Okay. I left open because it's a mixed crowd here, not men and women and not black and white, but people who care deeply about this banking regulation stuff and people who don't. So I'm leaving it open. If you guys want to get detailed with...
That's so good, because at cocktail parties, I only encounter the latter.
Only the latter. If you want to ask those deep questions, be my guest, or we can ask sort of broader questions. It's really up to you guys how you want to handle this. We've got about 15 minutes. Am I right about that? Yeah. Yeah, okay. Right there.
So there's been a lot of discussion of Facebook Libra. So do you want to echo or add to the comments by the Fed chair today?
So with respect to Libra and stablecoins generally, right? So let's talk about the implications of a broadly adopted stablecoin. Up to now, in the international discussions, it's something that we've talked a lot about at the Financial Stability Board. The conclusion has been, crypto assets are just not a big enough thing to raise financial stability concerns. They raise consumer protection concerns, they raise potential facilitation of criminal activity concerns from the official sector, as well as their positive benefits. But they just aren't big enough. You'd never guess that from the amount of space they take up in the paper, but they just weren't big enough. Something like a stablecoin, which does away with some of the volatility that has made crypto assets up to now not usable widely as mechanisms of payment. Something like a stablecoin that is placed on a widely used platform, that changes that analysis. And so in the international discussions, one of the things that came out of the G20 summit in Osaka very recently was a mandate to the Financial Stability Board to look at the question of stablecoins and to say, what ought we to do about that? And so at the FSB, we will be taking that on. Now, I'm not prejudging what the outcome of that analysis will be, because up to now, on the basis of don't trouble trouble till trouble troubles you, or sufficient unto the day is the evil thereof, having concluded that it's not a big enough thing to worry about, we haven't worried about it. And now I think we do need to think about it, and there are clear benefits as well as concerns, and we'll be deeply engaged on them over the course of the next several months.
Does that mean it comes up at the next FSOC meeting? Is that on the agenda?
So the agenda for the next FSOC meeting has not been developed yet, but I certainly we will be discussing it interagency. So I'd be surprised if it doesn't, whether it's the next meeting or thereafter, become a topic of discussion at the FSOC. Yeah.
Gentleman back here. Do you want people to identify themselves? Is that? Yeah. Why don't you say your name and where you're from?
So Andy Navarrete from Capital One, thank you for joining us. And by the way, with the Trading Places reference, your legend only grows. So one of these geeky regulatory questions, which is the implementation of 2155. You released some capital relief rules here recently. Obviously had the FBO proposal out. Can you give us a sense of is there an effort or a conscious thought about coordinating the timing of these various things so that the domestic rules will be released with the foreign bank rules and then maybe tied to that April 1st implementation date next year? So I realize you're limited in terms of your comments, but just any sense of where we are in the process.
I mean, it is our objective to try to have them complete at the same time, and I don't think, life being what it is, maybe that could slip a little bit, but our objective is that we would not have any significant period of time where the domestic tailoring piece was complete and the foreign bank tailoring piece was not, because that wouldn't be consistent with the obligation that we have, I think, under the law to ensure that we take into account national treatment and that our foreign and domestic firms are treated similarly. And now on the timing of when that synchronization happens, I don't think that it's inappropriate. There's a lot that I can't say under the Administrative Procedures Act with something that's out. I don't think, however, that it's inappropriate for me to point out what most people would think is that I'm supposed to testify on these matters again in the fall, and that will be an exceedingly uncomfortable testimony. If I am still saying, there are a few people I see in the audience whose job it will be to ensure that I am made exceedingly uncomfortable if we don't have something to show them.
Gentleman over here, and I'll come back to you.
Since there aren't many questions, I thought I'd throw one in from the Cosmos view. Carl Pulzer, I do a little project called the Center on Capital and Social Equity. It explores the dynamics of wealth concentration and advocacy-wise tries to include people at the bottom in the financial system. So it has to do with credit card and debit card fees. Like since the recession, the great financial crisis, I've been reading that more banks, the larger banks, depend more, for their profits on transactional fees, not taking risk. 1 to 3% swipe fees for credit and debit cards. The Chinese have developed a payment system that has much lower rates. One could argue that this is a deadweight loss to the whole economy because the merchants raise the prices for everybody, particularly for low-income people spending cash. I was wondering whether when you evaluate large banks that do a lot of transactional, do you build in the fact that they're taking less risk? And within the competition among banks, how do the small banks that you say really depend on taking risk fare against the larger banks that do a lot with transactions?
So, I think there are a lot of points there that we do get a lot of consideration to. So to take them maybe in reverse order, hoping that I don't, given the weaknesses of memory, then forget what the first and perhaps most important was, but the most recent one. How do the small banks compete with the large banks? I think that their business models allow them to compete pretty effectively because they're serving a customer that is particularly important with respect to job creation. That it is harder for the large banks to effectively serve. And as I say, during the period of time that I was an investor in small banks, I became very convinced both of the benefits of their role in our system and of their ability to compete. I mean, I wouldn't have put money into them if I didn't think that they could, in fact, compete in that niche. So I think that's okay, although we have to be very vigilant as regulators that because of the social benefits that I think come from that highly diversified structure of our banking system, we have to be careful that we don't make it too difficult for banks of that size to be able to exist because of the cost of regulatory compliance. And we have tried to be sensitive to that in the various tailoring proposals that we have put out to ensure that smaller banks, they do need to be regulated as a group. They can have systemic significance. There are a number of folks here I know who lived through the savings and loan crisis. There weren't a lot of big ones there. But they can't. They simply can't be profitable at the level of with the level of regulatory compliance that we would require of a larger firm. So I think we have to be sensitive to that. On the question of fees, I mean, that is an issue that was a very live one for the Fed right now. I think most people know that we're considering whether the Fed should have its own offering in the area of real-time payments, which is expected to greatly reduce the cost of payments transfers in the United States, both domestically and internationally. It certainly has the potential to do so. And I would, and so I think those are probably among the ways that we can most I don't know what the answer is going to be there, but I think that that question of cost of payment services and equity in the system is one that we need to consider as we make that analysis.
I think we have a last question over here.
Hi, Victoria Guido with Politico. I have a question that kind of connects some of the dots on things that you've said on the countercyclical capital buffer. So you've been talking more and more certainly about wanting to think about the British framework for the countercyclical capital buffer. And then your comments this week kind of suggest that, with you saying that the countercyclical capital buffer is sort of effectively on given how high capital requirements are. So if you did want to be able to turn that down, that seems like something that you'd want to put in place sooner rather than later. So my question is, should we be expecting a potentially imminent change to the countercyclical capital buffer framework, like in the stress capital buffer proposal or something like that?
Well, so I don't think that you should necessarily be expecting it because that is not something that that the board as a whole has considered yet. And all of these measures then require discussion amongst all of us. But it is something that is, that we have been discussing. So I don't think that you should necessarily be surprised by it. But it would be very premature to say that you should be expecting it.
There's a lot that just went on there. I'm looking at Victoria to see if she understood what Randal was saying. I'm trying to figure out if I understood it. You don't want to follow up? You're good?
Sounds like you're saying that that's a possibility, basically.
That's fair.
Okay, let's leave it there. Thank you all very much. Please join me in thanking Vice Chairman Quarles. Thanks very much. It's really great, Randal. Thank you.
Whatever, take the chair. All right, as we transition to the next panel, I want to quickly thank Mr. Leisman and Mr. Vice Chair Quarles for a thoughtful Q&A session. I am John Sarushian. I'm a senior policy analyst here at the Bipartisan Policy Center, and I lead our work on financial regulation, where we're looking at issues such as post-crisis financial regulation, the transition away from LIBOR, and the rise of artificial intelligence and what it means for the financial sector. I want to take a quick moment to thank Mr. Winter, who I think just left, for accepting the Patriot Award on behalf of Dr. Rivlin. I worked with Alice closely at the Brookings Institution, where I was her research assistant, and she served as a real positive role model and inspiration for many people that were at the Brookings Institution, many people I saw her interact. Words cannot really describe the sorrow I feel or felt when I learned of her passing, which is why I'm actually grateful that BPC has decided to make this a memorial event for Dr. Rivlin and dedicated this event to her. So in memory of Alice and her love of thoughtful debate, I'm actually excited to have a distinguished group of panelists to react to what Vice Chair Quarles said. So let me quickly introduce them. To my immediate left is Nellie Lang. She is a senior fellow at the Brookings Institution. To her left is Greg Baer. He is the president and CEO at the Bank Policy Institute. To his left is Patricia Mosser, who is a senior research scholar of international and public affairs at Columbia University. And to her left is Peter Fisher, who is a professor at Dartmouth University. Thank you all for joining us. And let's begin where the Vice Chair and Mr. Leisman ended. So Vice Chair Quarles talked about a variety of issues, including monetary policy, counter-cyclical capital buffers, and capital requirements. Can you give us your reaction to what you heard and maybe give us some of your main takeaways? And we'll start with you, Nellie.
Okay. So thank you very much for the invitation to be here. It's fun to always to talk about these issues, especially after Vice Chair Quarles. So I thought I'd pick up on two issues, and one is first the monetary policy and financial stability issue, and the close interaction that I think his remarks reflected, that these are intertwined issues. And I think the way I think about it is, if you didn't have a resilient financial sector, if you had a weak banking sector or a weak infrastructure in financial markets, the central bank, as a monetary policymaker, has much less room to maneuver. So currently, it can think about cutting interest rates, and evidently people are starting to price that in, and the chairman's testimony this week doesn't seem to be pushing back up against that. But he has that flexibility because when you cut rates and you expect to increase credit and you expect it to work through higher asset prices, the banking sector is very resilient and can absorb and not create additional risks from this, risk to financial stability. So if you've got a again, a stable sector, financial sector, you have much more room to work on monetary policy. So I think his remarks reflected that, and I think that's an innovation in some sense for advanced economies since the financial crisis, how monetary policy can affect financial conditions. The second point is on countercyclical capital buffer that he raised. And he raised it in the sense of this being a macroprudential tool. So if you have issues with an economy and a financial sector, it's always better to have more tools than less. And just using one interest rate to try to address everything, you're going to run into problems. So countercyclical is a possibility, which is, as he said, to raise capital in anticipation during good times, in anticipation of when times turn down, and then the banks would have capital they could release and continue to support and lend and support the economy. I think his point being that in some sense the U.S. has it on already, but in a much less flexible way is something that it sounds like, this was the interaction between Victoria and him, that Steve said there's lots going on beneath here, suggests that the next proposal, the SCB, might try to address this. So currently, a lot of capital requirements from the stress test are because you're pre-funding shareholder payouts. So as long as you can shut those shareholder payouts down once a recession turns, you can continue to support the economy. But if you can't, then it's possible banks just pull back on lending once things slow, and that contributes to a slowdown. If you could, instead of pre-funding quite as much of the share repurchases and substitute a countercyclical capital buffer for it, it eases up a bunch of financial constraints. I wouldn't be surprised if they try to work something like that in. Okay, so those are my two comments to start.
Great, thank you.
Greg?
First, the thing I most appreciated was the Trading Places reference, simply because it's the first lowbrow reference he's ever made. It's usually 18th century French poetry or Thucydides or The Lord of the Rings, God help us. So at least I was able at last to relate. On the CCYB, I mean, I will say I've always been a CCY skeptic for at least 4 reasons. One, it's premised on the notion that the Fed can, with great accuracy and prescience, figure out when the next financial crisis will be, or next source of financial stability. Second, it's not targeted by asset class. So if you believe the next source of instability is, say, leveraged loans, you're imposing a capital requirement on mortgages and credit cards. And it's incidentally trading in those assets, which might actually be counterproductive. Third, it's only targeted at the largest banks. So if you believe that financial activity will move around and you really want a macro tool, only targeting a subset of banks does not seem particularly effective. And then lastly, which I think the Vice Chairman got to, is I worry about the political reality of turning it off or reducing it. I always picture him having to testify before Congress, Chairman, Ranking Member, we're in the midst of a great financial crisis, and that's why I'm here before you today to lower the capital requirements on the largest banks in this country. And I know that the UK has managed to do that. Maybe that's because they're a parliamentary democracy or have different traditions, but I have deep skepticism about whether that could happen here. That said, and I think it's an important that said, I do agree with him completely. The chances of that happening are much greater than reducing the G-SIB surcharge in the midst of a crisis or reducing the minimum capital requirement in the middle of a crisis. So you can at least see a world where that can happen, whereas right now I don't see any world where that can happen. And that gets to one of my fundamental concerns about current regulation. It's what I refer to as the great buffer fallacy. If you think about regulation now, the idea is in a crisis we want banks to not only be safe but also to continue lending basically as if nothing has happened. Now you can argue whether that's an appropriate objective for regulation. Is it just to protect the deposit insurance fund or is it actually to protect the economy? But I think that's a sunk issue. But if you believe that, how is that actually going to work? And you have now the countercyclical capital buffer potentially, but you certainly have the capital conservation buffer, you have the G-SIB buffer, and the notion is that banks will draw, and in the liquidity world, you have the LCR where there's a buffer above 1.0, and the belief is that banks will draw those down in the interest of the economy and society and continue to lend. I have never believed that. In fact, I don't know any market participant who believes that. They all believe that banks will husband their capital and liquidity so as not to show weakness to the market and not to show weakness to the regulator. And if you believe that it's all a great buffer fallacy, then banks right now are holding vast amounts of capital with a reduction in economic output for no purpose. So I think in his construct, the notion that some of that buffer could actually be reduced by the regulators and without a reputational or enforcement risk to the bank, that's a very interesting idea. Then in effect, you're lowering the buffers that can't be used in place of one that the Federal Reserve could lower with a real impact. So that was my main takeaway. The only other thing I would say, because Libra came up at the end, and we've obviously been following that quite a lot. I mean, it's really interesting. I thought it was particularly interesting that it was pitched largely as an international remittance sort of offering, more in competition with Western Union than some of the banks. And you have to wonder, why is that niche there? And I think it gets to a lot of issues we've been working on, seemingly unrelated. Things like, why are banks having under the AML laws to have to de-risk and not be internationally active as much and deal with correspondent banks? It also gets to the question of how clunky international payments are. I mean, clearly, if you had the ability to, with no transaction costs, to transfer a dollar to someone in Somalia or Albania or wherever versus transmit a Libra, I would think everybody would say, well, no, just send a dollar. But that's not currently possible for a lot of reasons. I think that's why you've seen now the largest banks are setting up a real-time payment system. We actually set it up last year, which is open and operating at least domestically. There's no reason that couldn't be expanded internationally. It's built on the same standard as international systems like that. So I think what's really interesting about Libra is not just Libra, but what it says more broadly about how we do payments in this country. And I think that's going to be a fascinating debate.
So again, I want to thank the Bipartisan Policy Center for inviting me. I'm going to pick up on also what Governor Quarles said about monetary policy and financial stability, but in a way that's a little different than slightly different angle than what Nellie did. We do know actually a fair amount about macroprudential tools. We just don't know very much about how they work in the United States or most advanced economies because we abandoned using them for about 50 or 60 years. But the rest of the world has used them quite a bit. And that particularly in smaller and emerging economies. Now, there are reasons that their experience may not be fully translatable to the U.S., but there are some lessons from there, and particularly the interaction between macroprudential tools like the countercyclical capital buffer and monetary policy. And one of the things that we've learned increasingly, and there's a few studies on this, is that if you have what I call the double bubble problem, when you have big increases in asset prices, lots of increases in credit, and your economy is booming, pushing both those sets of tools in the same direction, it has a multiplicative effect in addition to the sum of their effects. In other words, they're better when they work together. So hiking monetary policy maybe a little more than you would otherwise, and also using macroprudential tools helps you basically try to slow down that sort of aggressive overheating in both finance and macro, and therefore hopefully prevent the really devastating downside on the other side. But when they work in a different direction, when you have an economy maybe that's doing all right on growth, but inflation's a little too low, but you have a bubble in, say, house prices, and you want to use macroprudential tools in one way or monetary policy in another, that's where you end up having a few more difficulties and where the effectiveness is not so good. Moreover, this debate about, well, should we use monetary policy or macroprudential tools? There's a really interesting recent example, also outside the United States. The Swedish central bank actually had exactly the situation I just described of low inflation, moderate growth. Really should have kept monetary policy relatively easy, but they had a house price bubble. And so they steadily, over the course of a couple of years, raised interest rates, or maybe it was only a year and a half, raised interest rates, not what their usual monetary policy should have been in such a world. Turns out the economy slowed way down, inflation fell further. They basically lost their, shall we say, credibility temporarily. Markets basically abandoned their forward guidance and what they said they were going to do because the markets looked at the real world and said, you're not going to keep doing this. We don't care what's going on with house prices. If your economy falls apart, you're going to ease monetary policy. And that's indeed what they did. So if you want to be skeptical about the use of monetary policy to prick bubbles, that's an interesting example. One last note I want to say about macro tools that we know is, and here is unfortunately, the unfortunate thing for the United States is that it really is working with 1.5, I guess, 7 fingers tied behind its back on the macroprudential tool side. Studies show pretty consistently that the most effective macroprudential tools are those that limit leverage in the real economy. In other words, to limit the leverage that households and businesses can take on. They tend to be very effective. They're also wildly unpopular, and are much, and indeed are basically not possible to do in the United States at all. In some countries you can, but certainly not here. Financial leverage tools like the countercyclical capital buffer, they have less of an impact. I think what the vice chair said is exactly right, particularly in pricking the bubble. It's good to have the extra capital, but the reason you want it is to cushion the downside when the bad comes, and therefore being able to remove the countercyclical capital. If you think that's politically tough, putting a limit on how much leverage people can have in their houses is really, really unpopular. So I think those who in the United States, like Jeremy Stein and others who think about monetary policy this way, and maybe it should be a tool, I think partly reflects that reality, that the tools in the United States are just incredibly limited. One last very minor comment. About the countercyclical capital buffer, I found the Vice Chair's comments very interesting. But I think the piece that's missing, and that Nellie and Greg alluded to, is the piece about where the stress tests fit into this. Because the binding capital constraint for all of the large institutions is are the stress tests. It's not any regulatory capital ratio. And so the question is, if that is not going to change, how does that fit into any recalibration? I think that's an incredibly important piece. I don't think you can just do the capital rules and just do the countercyclical alone. Somehow you have to figure out how you're going to fit the stress testing regime in there too.
Thanks. Anything left? Let's see.
Sorry.
A couple of comments. Let me say I think I know well both Steve Leisman and Randy Quarles, and for many years, and a fan of both of theirs, and it's a real pleasure to be here with all of you. I think Steve missed the importance of what Randy said in Boston earlier about stress tests. The point is not to fail, the point is to learn. And as a professor, I assure you, the risk of failing my course is only to help the students learn. I don't seek to have the students fail. But having a little edge on it helps them learn. And risk management is about learning. If it was quantitative and we could just run a model, we wouldn't have to be learning from it. And I think that was a really important point the Vice Chairman made in Boston. I'm going to take the other side with Steve's opening question. And I'm not at peace with Randy's comments about credit and financial stability and monetary policy. And I think it's likely that supervisors, once again, as they have for most of the last 40 years, will be the fall guys of the next recession. Right? It's happened every time. And that's because monetary policy and macroeconomics, particularly in this country, has a big blind spot. It does not want to recognize the central role that the growth of credit plays in stimulating the economy. That's how monetary policy principally works. There's some other channels. There's some other ways monetary policy influences aggregate demand, but it's mostly through the growth rate of credit. And the reason I can say I think the Fed's been in denial of this is how hard they've worked to avoid the actual language of their statutory mandate from Congress. Section 2A of the Federal Reserve Act says the Federal Reserve Board of Governors and the Federal Open Market Committee shall maintain, note the statutory imperative. The use of the word shall in a statute means it's the thing you have to do. Shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production. That's most of the words of their actual mandate, so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. Don't grow credit faster or slower than real income grows. Every banker knows that's a sensible strategy. You don't want to be lending to someone you're lending him more money than he can pay out of the real growth of income. So that's their mandate. And the reason I know they're in denial is because they're avoiding those words like the plague. because it constrains them, because it's a statement of means, not ends. And financial stability is not a sideshow. Financial stability is the principal deflationary threat to price stability and employment and output growth. It's not some second-class set of problems, as we learned in 2007, 8, 9, and 10. And yet, monetary policy has what I've called elsewhere in this town a hemianopsia. That means a partial blindness. You only see half of what's going on in the world. If you don't recognize the centrality of credit to how monetary policy works, you're going to engage in this false dichotomy between monetary policy and financial stability. And Paul Volcker never thought of it that way. He never thought bank safety and soundness was somehow divorced from monetary policy. Maybe we'll come back to that. I just wanted one more note on Libra, and I think the Vice Chairman's comments were on the mark, but I'll go even further. If you want to invest in something that has no intrinsic value, a cryptocurrency, be my guest. If you want to put deposits somewhere and then transfer them to other people, we have ways you do that. You can charter a bank or you can open a money market mutual fund. Period.
Thank you. All right, so one of the common themes I heard a lot about was with regards to macroprudential policy, both the countercyclical capital buffer and the stress tests. With regards to the stress test, I've heard this is the big constraint for the major banks. And I heard the Vice Chair and Peter say sort of stress test is a way to learn and not necessarily designed to fail. Nellie, you were at a conference, I believe, a couple days ago on stress testing at the Federal Reserve Bank of Boston. And I believe you presented a paper with former Vice Chair Don Cohn. Right. A lot of Vice Chairs of the Fed coming up in this discussion today. Can you talk a bit about sort of what was talked about at that conference, what was learned, and maybe give us an overview about sort of what you discussed in your paper, and I'll give the other panelists a chance to react after you sort of respond.
So the impetus for the conference was to get public input into design of stress tests. Are there ways to improve the transparency and the efficiency of stress tests while retaining their rigor? And so they invited a number of papers from outside for academics to write. The one I focused on was trying to understand what effects the stress tests have had on sort of broader economic and financial conditions. So you try to think about stress tests separate from higher capital requirements. And so what is it about stress tests that might change bank capital or the effect on credit provision, or does it change risk management in a way that just static capital requirements would? I think some of the takeaways were, it was clear the Vice Chair wanted to improve transparency and work with the banks a bit more on this. And I think there is this balance that he recognizes of, you got to have a little pressure there to force students to learn. Yes, of course you want them to learn, but there's got to be a little pressure and some on them to do so. One takeaway that I think I wanted to make at this conference was the stress tests are the binding capital requirement. A lot of the current capital buffers are because of dividends and share buybacks currently. Some of it is net losses, but the economy is in good shape. Balance sheets look pretty good. The bank credit quality looks pretty good. So it's hard to stress and get a lot of losses out of that. It leaves the banks pretty well capitalized now. And so there might be some trade-off. I think earlier I said that between the way the stress test is constructed and a potential countercyclical capital buffer. By the way, currently about 14 countries have put in place the countercyclical capital buffer, and it isn't only the small emerging market countries. So I think there will be a bit here. There will be some experience to draw on, not just the UK, but France and Germany and Sweden and Norway and a number of other countries. But part of the other piece, and this comes back to the monetary policy, financial stability, I totally agree with Peter. I always agree with Peter. But I do think actually the Fed is trying to incorporate financial stability, but in their the ideal world, you don't have to use the interest rate for it. You would have another tool. And they recognized the cost of excessive credit growth on the economy. That was the U.S. financial crisis. It's been the source of crises since the late 1800s, and so sort of crept in. But how do you do that? And is the interest rate the only way to do it? And I think that's why they've invested a lot of time to have banks with higher capital to keep credit growth down, or to be able to absorb losses and keep lending. So those are some of the takeaways from the conference that, yeah.
Greg, you want to react?
First, I think I'll add my own analogy to Peter's with regard to the fact that all the banks passed, and how surprised should we be about that. I mean, I think if you discovered that the 20 largest banks all paid their taxes this year and none of them committed fraud, you would not say, oh my God, we need to raise tax rates and make the tax code more complex. You would say, we have a tax code that is understandable, and they knew what the rules were and they followed them. I'd also add that one reason they pass is, and I think to societal detriment, is that they hold very large buffers above what they anticipate to be the requirement of that stress test, because they don't know from year to year what the scenarios are going to be or even what the model is going to do. So they are holding excess capital that in a perfect world perhaps they would not be holding. I should say about stress testing more generally, and I know sort of the level of interest here probably varies. I mean, you know, I think the industry has always been extremely supportive of stress testing, both as a regulatory tool and certainly as a risk management tool. Every large, and I think probably most small banks, do some version of stress tests. I've worked at banks that do hundreds. But it's really hard for the Fed because they have to take the stress test and come up with a single number. Like, here's how much you can pay in dividends or repurchases. Here's how much you would lose net, how much you would make. And that's really difficult to do in practice because it raises a host of issues. You know, we refer a lot to the mono model, mono scenario problem. I mean, if you think about what the stress test is every year, I mean, it varies a little bit in severity year to year, but basically you're assuming unemployment goes from wherever it is now, you would probably know, 3 to 10 over 9 quarters. And actually not even 9 quarters, it's a pretty sudden increase, unprecedented. That the stock market goes down 50 to 60 to 65%, that housing pricing decreased 30%. So this massive shock. And in effect, what you're saying to the bank is, we're judging you not based on sort of a judgment around 100 stress tests, but about one stress, that stress this year. So if you had a bank and you had some experience with this, you would run a stress test around, Russian collapse, credit collapse, European, disarray, war in the Middle East. But you would never say, oh, you know what, this year we're going to capitalize our bank based on Middle East war, and we're going to ignore all the rest. And so, I think that's the fundamental challenge with stress testing. It's why I think, we're concerned not only about the severity of the test, that is how out of the money those assumptions are, but also the volatility, that you go from a once every million year event one year to a different once every million year event the next year, and you can get very significantly different results for a given bank, even if that bank's assets are the same. And their risk is the same. And I think that's why it's not only a severity concern, but a volatility concern. I do think, under Vice Chairman Quarles' leadership, they are thinking this through in a very rigorous way. And we appreciate it. And I think there's increasing academic, focus being placed on this issue. I think our own folks at the Bank Policy Institute are doing a lot of that. And I think that's being pretty well received. But I would never underestimate what a difficult challenge this is, but also that it's a challenge well worth taking on, because if you compare that to, say, a leverage ratio, which is the dumbest way in the world to determine whether a bank has enough capital, sure, I'll take stress testing every time.
Okay. Talking about stress testing and sort of financial stability issues, Trish, I know you've been looking at cybersecurity as it relates to financial stability, and I believe you wrote a paper about this topic with a colleague of yours. Can you sort of talk about the link between sort of cybersecurity risk and financial stability and how you think about it?
Sure, I'd be happy to. It's a little bit like getting two different worlds to try to communicate with each other, because the folks who really, really understand cyber risk well don't tend to be incredible experts on financial stability or even the sort of basic dynamics in the financial system, whereas And vice versa, by the way. Folks in financial stability know enough to be scared, and that's sort of about it, about cyber risk. So my colleague, who's a security policy expert, a cybersecurity policy expert, and I have with a couple of co-authors, have written a couple of short policy papers trying to bring those two worlds together. And at this point, it's incredibly simple. Nothing that would ever go in a stress test. Let me be clear. But instead, I think, has to be tackled because the level of knowledge, frankly, in the two worlds is so far apart. Cyber has its own set of contagion channels, technology from within systems and even occasionally across systems. Financial stability, financial processes and transactions and institutions have another very complicated set of interactions with each other that can very occasionally become unstable, fortunately rarely. We have no idea how those two things interact with each other. I'm exaggerating, but not a lot. And increasingly, cyber attacks, if you hang out with national security people for very long, you will discover that they actually make financial stability people not look paranoid by comparison. But increasingly, the cyber attacks that both the private sector and the public sector appear to be most worried about are those that are not only obviously intentional, but those that are intended to harm as opposed to, say, steal. And given that, if there's intentional harm, then if the intent is to disrupt, then all of a sudden the ability to disrupt this ecosystem in finance over here, that should really, really matter even to the people who are just fighting the attacks all the time. And certainly the people over here who understand that ecosystem need to understand where they might be most vulnerable. And so our very high-level proposals are to talk about these two things together. But we're way, way, way far away from the level of sophistication where we go through the typical financial institution goes through a stress test, either an internal one or one that the Fed does. I have one reaction to the things Greg said. By definition, all stress tests are wrong, right? I mean, whatever stress they give you is never really going to happen in the real world. It's a question of whether it's severe enough, regardless of the source. But I don't think we're even at the stage with cyber that we can ask that question yet. That's just my 2 cents. May I add one other comment, sure, completely unrelated? I want to. Peter is absolutely right about credit and monetary policy. And one of the difficulties, now I'm going to really sound big picture macro, but one of the difficulties is, thank goodness, partly because of the robustness of the financial system and safeguards that we have over the last almost 100 years, at least 90 years. Financial crises are very rare, but the recessions that go along with them are massive, long-lasting, absolutely terrible. And that's true in every country for 150 years, as Nellie pointed out. But what's important, though, is that monetary policy models are calibrated to the garden variety recessions that happen every X years, which are quite different creatures, frankly. And if you are expecting, a thunderstorm and you get, a 2-mile wide tornado instead, you're not going to have the right kind of predictions. And that's the analogy I use and I think you're exactly right about when you really have to watch for credit is when you get that, what I call that double bubble effect. And that is very difficult to change gears, particularly when you've had 70 years of relative peace, I guess would be the right thing. So in defense of the monetary policy makers, I guess, I'm not really trying to defend them because I'm the first person to say monetary policy doesn't pay nearly enough attention to credit. But it's certainly understandable. So, sorry.
Okay, I'll let Peter react, and Greg, I think I saw your hand, so you can go next. So Peter, go first. Yeah.
Picking up this theme, and then I won't go long. I mean, Nellie's comment about, which I understand, we don't want to use interest rates. So there's some moment in the cycle where we don't want to use interest rates. Well, sometimes you don't always get what you want. And particularly in the United States because of our political economy. We are incapable of keeping credit inside the regulatory perimeter of the banking system. Compared to our neighbors to the north and south, to Germany and Japan, our shadow banking system is just, of all shapes and sizes. I don't mean to. And so the regulatory tools are not going to get there. So you're stuck using the interest rate tool in your double bubble scenario. You're just stuck, and you may not like it. You may wish you lived in some other country. But I think that this is what's so important, and monetary policy cannot shirk this. monetary policy has what I call the last mover responsibility. Regulatory tools, macroprudential tools, statutory tools, they're all really slow. Monetary policy has given us independence, and they can fiddle with interest rates and the balance sheet of the central bank, and it can move much more freely. And it can't wait around for the financial system it wishes it had. Oh, give me one that's more secure, in which we have all credit inside the banking system. It's stuck making policy with the financial system it finds in front of it. And that's where I find the shirking of monetary policy embarrassing.
Greg,
I just wanted to follow up a little on the cyber point. I think I just start by saying, I think traditionally we've been approaching this the wrong way. The analogy I always use is if an ICBM hit a bank branch, no one would make Vice Chair Quarles testify about that. Same if it was anthrax. But if it's a nation-state hack attack, somehow that's become his job. It didn't used to be that way. I mean, when I was at the Treasury in the late 90s, early 2000s, I was in charge of the financial services sector for critical infrastructure protection, including cyber, and spent a lot of time on that. And actually testified about a virus attack at that point. And it would never have occurred to anyone that the OCC would testify about that. That was our job. And somehow it became not our job, and it became the job of bank examiners to go out there and figure out if a bank is susceptible to a cyber attack. And by the way, a bank examiner with really very little expertise in this area, and in some cases at a bank with thousands of people with much more experience in this area. So I think that has translated into a focus on policies and procedures, and we hear reports that CISOs, Chief Information Security Officers, are spending 30–40% of their time working on policies and procedures and explaining those policies and procedures to regulators as opposed to sitting in front of their screens dealing with real attacks. I do think now that the bank regulators are aware of this and are really thinking about it very hard, which is very good news. We have a significant team at BPI in the form of BITS that works on these issues. They've come up with what we call the Cybersecurity Sector Profile, which is a common examination template that regulators around the world can use so that they each go into the bank that is internationally active and ask the same set of questions instead of duplicating. The regulators have been quite enthusiastic about that, including Secretary Mnuchin, which is great. So I think that's a good first step. There's a lot of work to be done on information sharing. I think there are some bright shoots. The industry has met to think about critical infrastructures within finance, including the payment system. There's which I actually helped co-found, the FS-ISAC, or Financial Services Information Security and Analysis Center, Information Sharing and Analysis Center, which has been around. We started with 10 banks. It's now, I think, 2,000 or some financial actors who share. The largest banks have something called the FS-ARC, which is much more focused on bigger risks and involves some other types of information sharing. So I do think there's a lot of very good work going on, and a lot of that now does involve the national security community. So yeah, I think it's an area where we sort of got off on the wrong foot, but I think now there are very clever people thinking about this in the right way.
Okay, and Nellie, did you want to react to something Peter had said?
Yeah, can I just, so just back to monetary policy and financial stability. So you really hit a core issue. But I don't think, so I think if we just say you have to use monetary policy, and because financial regulations in the US can't get you there, you're settling for second best. I mean, there's no question that if you had more tools, it would be better than just having one tool. And so central bankers can say, well, we only have interest rates, and so we'll do whatever we have to do that because their financial regulations aren't going to work. Or the central bank could say, we need to make sure the financial regulations work. So that right now, if I think inflation's low and there's risk to the economy, I can lower rates and not worry about the double bubble kind of thing. But if you only have interest rates and no financial regulations, then you kind of have to make a trade-off now about whether you'd want to lower rates. So that's my only.
Of course, you have to muddle through.
Exactly.
But you don't get to say, well, I don't ever have to use interest rates.
No, I don't think I wanted to say that. Yeah, exactly. But just the general rule of more tools is better than fewer. And so.
What I was saying, back to sort of maybe what Peter was saying.
Yeah.
I mean, the one tool we're talking about is a countercyclical capital buffer that only applies to about a dozen banks.
Or the GSIB or the CCOB, the whole higher level of
But
capital.
in a world where vast amounts of American finance are outside those banks, you wonder about the efficacy of that tool. I did a note, actually, we've done a fair amount of work on the leverage lending issue, and I did a note saying, isn't it a leverage borrowing issue? And politically inexpedient for sure. But if you're really concerned about that, you would limit how much companies can borrow, not how much a dozen banks can lend.
Right. And I would say that is the role of
the corporate sector's the one who's near a leverage peak, not the household and not the financial sector.
So one issue that came up, one issue that came up at the conference on Tuesday in Boston was, well, when that happens, is the most reasonable outcome to say reduce regulations on banks or tighten regulations on banks? It's not clear. If you've got leverage loans and they're all outside the banking system, but they're raising risks, and I'm not saying they are systemic, but let's just say there's a big issue out there. Is the natural response to reduce regulations on banks or to increase them, even if they're outside the banking sector? So I think that there's really open questions about this, and sometimes people just say if you do it on the banks and it moves elsewhere, you shouldn't, you should loosen regulations on banks. But somehow risk has gone up in the system, so why are you reducing regulations? So I think it's a really interesting question. Things that I think all the financial regulators in the U.S. in total haven't quite sorted out yet.
I agree with that. And I think leveraged lending is sort of a cautionary tale, because everybody thinks of this as a now issue, but actually the agencies took significant action to curtail bank involvement in that market in 2013 and 14, with the belief that then was the looming problem with leveraged loans, which 5-6 years later it wasn't. And there's also, I think, a study by a couple of Fed economists that showed the result of that effort was not to diminish leveraged lending, it was simply to move it outside the banks. So I think that, to Nellie's point, you got to think, where is this actually going to end up in terms of risk across the system, and how macro effective is that really?
Yeah.
Okay, I'm going to open it up to questions. If anyone has any, raise your hand. Well, I think we have 10 minutes of Q&A, if I'm not mistaken. But if not, so the financial crisis was 10 years ago. There were a lot of lessons learned, probably some lessons forgotten, and maybe some lessons that were misunderstood. I'm going to open it up to any of the panelists. Are there any lessons learned, lessons misunderstood, or lessons that you're worried people are going to forget that you want to sort of raise right now? And okay, I guess everyone, no lessons learned, no lessons forgotten. Peter, actually, so you, go ahead, Nellie.
I can start with one. So I'll start with just sort of a call out to a book that Ben Bernanke, Tim Geithner, and Hank Paulson have written, and will be published by Yale Press this fall. And it includes a collection of 18 papers on the facilities, all the programs, all the facilities that were put in place to address different facets of the crisis as they unfolded. And it started with changes in the discount window, how the Fed used discount window. Actually, Trish was one of the authors of that paper. The papers are written by the people who actually had to put in place many of these programs. And I helped edit this book. I think one of the lessons, one of the key lessons actually relates to the GSEs. I think if there's going to be government involvement in credit, mortgage credit, there's an open question about whether you want government involvement in it or not. But if it is, it should be explicit. The worst outcome is implicit government subsidies, where expectation by investors that the government will support it, but the firm, a private firm, acts as if it's a private entity. So this is where the losses get socialized and the gains get political. So I think, to me, that's one of the key lessons. And so it's a little bit of too big to fail, but not really. It's more like this implicit government subsidy. I think that was the core of many of the underlying problems. So hope we don't forget that lesson.
I just want to say I strongly agree with that, and was part of some unsuccessful efforts to rein in their risk way back when. But it's also interesting now, and I think one thing that Steve and the Vice Chair didn't talk about, which I thought would have been interesting, is the interplay between monetary policy and liquidity regulation. Most people don't realize now that 95% of the federal funds market is the Federal Home Loan Banks as a counterparty, simply because, which have the same implicit guarantee that Fannie and Freddie do now, and certainly had pre-conservatorship. And the reason is because they're not subject to the LCR. So I think that's an area that certainly merits a lot more study, both the general interactions, but then particularly the role of the GSEs going forward. And I think consistent with that, and this will sound parochial, but I think the biggest misunderstanding of the financial crisis when I talk to folks who are new to it, including Georgetown law students whom I teach, is there was a banking crisis. And as I think Nellie alluded to, it's certainly partly a GSE crisis. I think when people couldn't roll over commercial paper, it was a corporate crisis. It was certainly, last time I checked, Lehman, Bear Stearns, AIG. So the easy answer has been, and I think it's because the people who ended up testifying were the banks, because they were the only ones left to hold the bag, and I don't know where all the mortgage brokers went. That's the people, that's what everybody remembers. And so it was a banking crisis, and it wasn't a banking crisis. And I think that has some lessons about the next financial crisis, which probably won't be a banking crisis either, because we have built a Maginot Line around the largest banks, and so the risk will go elsewhere, just as the Germans did way back when. No offense to my German members. That's right.
So I'm going to completely agree with Greg's last statement, and I have to say, writing and reading this book, sort of 10 years after, in addition to bringing back some memories sometimes I would have liked to have forgotten, the lack of understanding and preparedness, even amongst experts going in, was very high. Regardless of one's views about using monetary policy and the ex-ante part, financial stability is owned immediately and first in line by the central bank, because they are the lender of last resort. So even if you're not involved in the trying to slow down the double bubble on this side, they own the cleanup, or at least the first part of the cleanup. And the second piece of it was a lesson that the United States, I think in particular, had forgotten, which I do not know of a financial crisis across decades, across countries, going back as far back as we measure these things, where the government did not bail out part of its financial system. They just do it in the event. And it really sort of doesn't matter the politics of the government at the time either. So those two things suggest that implicit guarantees, meaning we're not going to whether you're a bank or not a bank, and it's mostly non-banks, implicit guarantees are very problematic, because if the world believes they're going to get bailed out, but there's sort of no constraints up front, then that's exactly what's going to happen. So I thought that was very telling. The last thing I think that the world has forgotten, or at least perhaps in the major economies we've forgotten it, is that this was not only partially a banking crisis, it was a non-bank crisis in the United States, but it was a global crisis, despite the fact that it was homegrown here. And the dollar as a benchmark currency is actually more important now than it was 12 years ago, substantially more important, which means the next crisis, even if it's not centered in the United States, is going to involve huge amounts of need for dollar liquidity all over the globe. And last time, just a little factoid, more than 75% of the dollars that were lent by the Federal Reserve through its lender of last resort facilities were lent to financial institutions whose home country is not the United States. So the dollar shortage, if you like, the liquidity shortage, was much worse outside from the rest of the world than it was here. That is going to happen again, is my prediction. I don't know when. It will be a difficult decision, because there's only one institution that can provide vast amounts of US dollars on relatively short notice, and that's the Federal Reserve. So I think it will be an interesting policy challenge for the Fed when the time comes. But it will be, that's not something the US can ignore, since we know from the Vice Chair's comments earlier, what goes on in the global economy, even if the US is doing fine now, is eventually going to kick back on us. So that's my other sort of thing we didn't know about that I'm afraid we're going to forget before the next one happens.
Two things that I think are forgotten or we make mistakes about. One was, and I really pick on something in Vice Chairman Quarles' speech in Boston, that the nadir of March '09, when we got the results of the first stress test of the top 19 banks, and that was an important moment, and the stress tests were important. But what really made it different was the courage of Secretary Geithner to say these 19 banks will not fail. And that's why Europe had a crisis for the next 3 years, themselves to say something like that. And it's again this awkward moment where you don't want to have implicit backstop, but you do. You're going to have it. And that was Tim Geithner's courage, and it was difficult for him, physically difficult. You could see him getting the words off was hard. But that's what turned the U.S. government collectively said, these 19 banks shall not fail. And everything got better after that. And I think we forget that. Something that we got wrong and Congress got wrong, you can amend the Federal Reserve's extraordinary lending powers if you want, if you're Congress. I don't want to say it's wrong for you to amend it, but I worry that Congress misunderstood what it did by limiting the Fed's 13.3 authority to lend to non-banks in extraordinary circumstances. There are two problems you might have been worried about. You might have been worried about the moral hazard of the Fed backstopping whole industries, or you might have been worried about the government picking and choosing winners and losers, that you don't like that. Now, the way Congress amended Section 13.3 was to fix the picking winners and losers problem and make the moral hazard problem worse. Because it says, it doesn't preclude the Fed from lending, it says the Fed has to lend to everyone on like conditions. Therefore, the next time, let's imagine non-bank drone financiers sometime in the future, and one of them behaves badly and two of them behave well. The Fed has to lend to all three or no one. And a little pop quiz for everyone here, still with us today. Who was the biggest recipient of largesse of the federal government in the crisis? It was not AIG. It was General Electric through the commercial paper program. But because they were part of a broad-based program, just like Section 13.3 now calls for, they didn't stand out because everyone got to come to the trough. So there was no stigma. Plenty of stigma attached to AIG. It's much harder. The implicit guarantee problem is much harder, and I think that's where we're misremembering the past. And it's not whether we made a mistake, it's just we have to remember more clearly what happened. Let me stop there.
It says we're out of time here, but I still think we have some time. I think, Nell, you wanted to make a comment. Okay, I want to take at least one question. This gentleman over here. Wait for your mic. Identify yourself and then ask your question.
Yes, I'm Alan Rivlin, and I'd like to bring Alice Rivlin's voice into this conversation because Cere and I got to spend a lot of the precious hours very near the end of her life as she was trying to say what was not yet in the draft of her book, which is forthcoming. And she reached a judgment on the question that John asked, which I'd like you to respond to. Her view, very clearly expressed, was that the bipartisan economic governing establishment should have anticipated 2008. Now, she reached this judgment in 2019, not in 2006. But she was very clear in saying she took no issue with anything that was done in response to the downturn, to the crisis, and the bailouts, all of that. But she really did lay at the feet of the bipartisan Washington establishment that the downturn was not anticipated, and carrying that further, that's why we have the rise of populism on the left and the right now, largely because they missed that.
Anyone want to react to that? We can start with Peter and then Greg.
I'm glad you brought Alice's cogent thinking into this problem. It doesn't surprise me that Alice, who I knew and had the privilege of working with, and she was so kind to me in so many ways, that she's asking a more sharp-edged question than what in England is called the Queen's question. Why did no one see it coming? The Queen famously asked when she was visiting the Bank of England Museum for an opening. Why did no one see it coming? And there's the sub-literature that's come out of people trying to answer the Queen's question and Alice's question. And my own answer goes to where I began, which is this monetary policy myopia about not recognizing money and credit. It's just not in the models. It's a little too complicated. It only seems to come up in the extreme cases. And we can do this without ever having to figure out how money and credit really work. And I'll just say On more than one occasion in the last 10 years, I've sat with what I thought to be very wise members of our Congress, people I really respected and admired, for whom I had to take them through, both parties, I want to be very clear, I had to explain how banks invent money. They did not get it. I had to walk them through the T accounts about how when you take out a loan from a bank, the bank writes up the asset liability side of its balance sheet, and money is created out of thin air. And that's something that, forgive the digression, but I think Alice might have enjoyed this. In the subtexts of the Lincoln-Douglas debates in Illinois in the 1850s, these two men are debating the finer points of banking policy. Farmers have ridden their wagons and horses for miles to come and listen to 3-hour harangues, much of which was on the technicalities of how banking worked. And you couldn't get a room full of voters today to listen to that. I mean, we've just lost it. And so we've lost something about how we understand money. We've glossed over it. And that's my best answer to what is a terrific question from Alice. Thank you.
I think Greg wanted to say something.
Sure. So when I do my lecture on the financial crisis, I actually start with a quote from Malcolm Gladwell about plane crashes. And the point he makes is that most plane crashes are not caused by one thing, some recent Boeing examples to the contrary. But they're usually caused by about 10 to 15 things, all of which you could sort of anticipate, but they all sort of play together in a way that nobody can anticipate, and that's why the plane crashes. And I think for the financial crisis, I think there's a lot of that. People didn't see how this could cause that, and a mortgage here in the United States could cause Northern Rock, and the reserve fund breaking the buck. I mean, so I think a lot of it was unknowable, particularly the interconnections. But I do think there was a bipartisan failure in certain fronts. The first of which Nellie was wise enough to mention first was GSEs. I mean, who didn't? I mean, we saw that coming 20 years ago. And that implicit guarantees would become and that there was moral hazard in the GSEs, and there was a political sort of bulwark against any reform of the GSEs. I think the failure to have any way to resolve a non-bank holding company, I mean, a parent of a bank or a Lehman Brothers, was a massive oversight, which somebody should have thought about. I'm not sure if that was a political failure as much as an imagination failure. And then the whole notion of, money market funds. I mean, it's sort of like GSEs. Anytime you're basing your regulation and a product on a lie, it's probably a bad idea. So the lie of GSEs was it's implicitly backed but not really backed. Well, no. And the idea of money market funds is we're going to post it's worth $1, but it's not worth $1. And so I think that was eminently foreseeable.
Okay. Anyone else want to react? Otherwise, we'll close the panel. All right. Well, what a great question to sort of end this panel on. Let's all give a round of applause to our panelists. And before we close, I want to quickly thank a few people who made this event possible, including Ariane Arias, Jack Rametta, Katie Sullivan, Alfredo Garcia-Sanchez, Jolene McNeil, Faye Power, Mr. Winter, who came here to accept the award on behalf of Dr. Rivlin, and Mr. Rivlin, or Alice's son, Alan. Thank you all for coming. And thanks. Bye.